Welcome everyone. In today's video I wanted to talk about Juiced Finance, which is a basis trading protocol here on Solana. So it's built on top of Mango markets. If you're not familiar with what basis trading is and how you can benefit from it, I can just refer you to one of my older videos. If you're not familiar with perpetual futures, essentially they're a derivatives product that allows you to get leveraged exposure to whatever the underlying asset is. So we have Sol perps, Bitcoin perps, ETH, Luna, Avalanche, and BNB perps. And Drift protocol allows you to deposit stablecoins, use that as collateral to then go ahead and buy these perpetual futures or sell them if you want to as well. And so we have here what's known as a funding APR, right? So this funding APR basically just takes the predicted funding rates and then multiplies it on like a yearly basis. So if you were to go long this ETH perp, you would be paying 68.25% of your position in order to do so. However, if you were going short the ETH perp, you are getting paid 68.22% on your position to do so. Now they have these funding APRs in place in order to ensure that the perpetual futures contract stays in line with whatever the index price is. So we can see here that the perpetual futures price is $3,919, whilst the index price of Ethereum is actually $3,913. So what it shows you here is that people are very bullish Ethereum, and that the perpetual futures price is above the index price. And so in order to encourage that price to go back down to the index price, we have the funding APRs. People who are going long the Ethereum perpetual futures might see that they're having to pay like 67, 69, 70% APR in their position to stay in that position. So they might think to themselves, you know what, it's not worth it. So they'll close their position. And when they do that, it will help the price of the perpetual future come back down to where the index price is. Additionally, it encourages people to go ahead and open up short positions, which is what we're going to do. And when you open up a short position, you're able to harvest this funding APR every hour. So if you are going to go short the ETH perpetual future, you'd get 0.00773% of your position back. I think this is every hour. Yeah, funding rate is calculated every hour. So every hour you'd get that much of your position. So we're doing this with the ETH perpetual futures today, but you can do it with the Sol perpetual futures, Bitcoin, Luna, Avalanche, BNB. But if you're going to be short selling, you want to do it when the funding APR is positive. That's when the longs pay the shorts. If the funding APR was negative, then the shorts would pay the long, and you'd have to do essentially just flip that trade. So we have Solana, so that's paying out slightly more. Bitcoin's paying out 40%. Luna 29%, so we'd want to go for either ETH or Sol. Avalanche is currently sitting at minus 44%. So what you'd want to do here, Avalanche is sitting at minus 44%, and then BNB I think also has negative funding. So just to show you here what I'm talking about, what happens is you're shorting $400 worth of ETH perpetual futures, and then you're long $400 worth of ETH spot. And that effectively gives you 0 ETH exposure. So in your portfolio, you will have 0 exposure to ETH, but the total value should still be $800 no matter where the price of ETH goes. ETH could go up, down, sideways. It doesn't really matter because your long and your short balance each other because your long and your short position balance each other out, and then your $800 should hopefully stay a stable $800. So the value of your portfolio would be $800 plus whatever yield that you're generating here. So the funding APR is 69.5%, but we're using $800, and $400 will be on Drift. The other $400 will be off of Drift in a spot ETH position. So the actual yield that you're receiving is going to be 35% roughly. So you're generating 35% APR on stablecoins is effectively what you're doing. The trade that you've created is a synthetic stablecoin. And there are protocols out there coming like UXD protocol, which gives you a yield-bearing stablecoin, but they won't be going for as risky of a strategy, and you won't be receiving anywhere near as much yield. So you know what? I'm going to talk to you more about how this works. So Okay, so now that you've seen that video and you understand exactly what basis trading is and how you can profit from it, let me just get into Juiced Finance. So effectively, they are built on top of Mango Markets instead of Drift. So, you know, the same principles apply, except it's easier actually to do a basis trade on Mango Markets because you can use lots of different tokens as collateral in Mango Markets itself. Whereas on Drift Protocol, they only accept USDC for now. So that's why this is built on top of Mango Markets and not Drift. But effectively what happens here is that they just do all of the basis trading for you, so you don't have to worry about managing the trades or having to flip long or short depending on the funding rates, which is really nice. So effectively what you can come and do is you can deposit stablecoins into either one of these cartons that they call it. So they have the Sol strategy and the Bitcoin strategy. So effectively, you just deposit USDC in here, and then it will more automatically start basis trading with it. And they estimate, you know, a 30-day return of 10.17% APY in the Sol carton, and in the Bitcoin carton, it's 8.3% APY. So if we just look at Mango Markets itself, we can see here the funding rates, you know, it's 12.78%. You know, that kind of makes sense as to what we've seen here on Juiced. If I go on Bitcoin, yeah, the number's negative. So, of course, you know, it's not going to be quite accurate. And this is just an estimate of the 30-day return. But it's really nice using this because it's a sustainable way of getting stablecoin yields compared to traditional yield farming. Because, you know, with most traditional yield farming, you're getting paid out your rewards in inflationary tokens. For example, you can provide liquidity on Saber, and most of your rewards are going to come from the Saber token, and you have to sell off that Saber token in order to realize that yield. Whereas with Juiced, you don't have to, you know, you get your yield back in USDC, which is quite nice. So as of right now, the TVL cap, I think, is at 100K. So once they got to 100K deposits, they weren't accepting any more. So I don't think you'll be able to deposit anymore for now. You know, if you follow their Twitter and their Discord, they'll update you as to when more money can actually come in and you can deposit it. Because, I mean, this protocol is still very much in its, what you see here, in its alpha stage. It is unaudited software, and, you know, obviously use it at your own risk. It's nice that they're doing this because I think if they, you know, ups the cap all the way to like millions and then it just immediately crashed Mango Markets, that would have been no good. But yeah, this is really cool. Definitely use it if you're looking for stablecoin yields. I'm like 99% sure that this isn't going to be a rug pull. I've covered, you know, this protocol on my channel before. In fact, I think they were in the Solana Ignition hackathon, if I remember that correctly. And so I think the devs are doxed, and they've worked with other notable devs in the ecosystem as well. So I trust the people behind it, but of course there is always smart contract risk. So if you're worried about that, then you know, perhaps don't use this, and, you know, wait a few months before they get audited and so on and so forth. But of course, you don't have to use Juiced Finance. I mean, you can go out and find better yields out there. For example, on Drift right now, Luna, you're getting paid 115% APR to go long. So thank you for watching. I hope you enjoyed this video, and make sure to subscribe for more videos like this one.